afternoon session. So coming up first, we will have Ms. Joycelyn to talk about digital insurance and where is the tipping point. Joycelyn is heading the life and health solutions team for Southeast Asia and India in Swiss Re. Experience total in 15 years in the industries, working with direct insurers, management consulting firm, as well as reinsurers. Joycelyn, passing to you.
Thank you, Robin. Hello, good afternoon, everyone. Let me just start by sharing my screen. Are you able to see my screen, Robin?
Yep, all good.
That's great, yeah. Hi, everyone. So my name is Joycelyn, and I joined Swiss Re 4 years ago. I'm currently leading the solutions team for life and health for Southeast Asia and India for Swiss Re. And my job was pretty straightforward. We create innovative life and health products for the insurers. So in Swiss Re, we have long realized the powerful driving force of digital transformation. But it's not until about 2 years ago when we started to bring it to the core of what my team does at Southeast Asian market level. Now, we have all heard that incorporating digital capabilities and connecting with ecosystem is essential to the long-term future of insurers. But for the vast majority of us, the promise of insurtech innovation has yet been realized. And we see many failed attempts when companies charge as digital agenda, especially when it comes to the complex life and health vertical. So could digital insurance ever leap over that tipping point? And could it become mainstream when we put side by side with the traditional channels such as agency or banker? This has been a question that I have found myself constantly asking for the last two years. And in this sessions, I'm going to dive a bit deeper at the various root causes that I see and to share with you in some of my observations around Asia and why I believe that the tipping point may be nearer than we originally expected. So first of all, before we start, is a few minutes for polling time. So if you could pull up the polls over the screen. So you can see on the screen right now, there are 2 questions pop up. The first question is pretty simple. Do you think digital insurance is here to stay? And by digital insurance, I meant digital insurance that is distributed digitally in oppose or in competition with traditional distribution channels such as agency or banker. So very simple questions. And the second question that I have for you is, what do you think, or what have you observed so far is the biggest challenge to promote digital insurance? Whether it being channel conflicts, whether it's huge investment versus the seemingly minimal value that the insurers tend to generate from this channel, or whether it's a lot of effort into building up a small volume of small ticket items that we are launching. Low conversion rate or regulation. Or lastly, you're just not interested in the agenda at all, and you don't believe that digital distribution is going to be here to stay. Okay, so those are the 2 questions. Maybe I'll give you another 10 seconds just to quickly run through. And we'll close it. Okay. I guess that's enough time. So Robin, if you could help me to close the poll and let's see the result. Whoa, astounding. We have a very forward-looking audience over here. Yeah, I think I'm lucky to be the last few who presented. So maybe after the first few discussions today, you're all convinced that digital insurance is the way forward. And on the second part, having said that, I think a lot of you also see quite a fair bit of challenges for us to promote digital insurance across the industry. And the biggest one, channel conflicts. Yeah, 64% of you believe that China conflict is the reason why it is not gaining the traction as we want it to be. Huge investment, low conversion rate. So all these challenges are very real, and my team, face them every day across the various different markets in Asia. So we know that these are quite common hurdles. So let's get down to examine some of these challenges in further details. For the last decade, insurance has been the one industry that promises disruption. In fact, the promise was so profound that all across the globe, insurtech is one of the sectors that attracted the most funding from venture capitals. Even when our economy contracts in face of pandemic, the total funding rose to 13 billion by Q3 of this year, and it's 5 times of that just 5 years ago. To give you a bit of perspective, the total venture capital funding for all industries was at 96 billion this year, which means that insurtech alone contributes to about 15% of this number, which is very impressive. But in contrast to the amount of the money pouring in, the number of insurtech launch is actually reducing, signifying we are entering into a period of consolidation across the insurtech sectors, which means that the business models that we are starting to see today are converging and tends to be more sustainable in the long run. Another figure worth looking at is the share price of some insurtech players. While both Metromile and Lemonade are the unicorns of the US insurtechs, how they performed since the IPO is a stark difference. Metromile lost about 64% of their initial IPO price, while Lemonade gained 200% over the initial launch. And if we look closer to home, Waterdrop, being an uprising insurtech in China, whose business model is to provide illness insurance through crowdsourcing, also has its share price dropped by 80% just 2 months since the IPO in New York Exchange from May this year. I just checked it last night and the price is now below $2. So it seems pretty hard to understand at first, all the opposing movements. But then again, our industry is known for veteran brands and a cautious approach to risk. And the public investors tend to be very wary when it comes to this risk business. And the slightest hiccup and the market seems to be particularly unforgiving. Another fascinating trend is the invasion of big tech companies into insurance. So we have seen the biggest names such as Google, Amazon, Apple, continuously looking for ways to offer insurance to the user base. And this trend is unavoidable, right? When we all believe that the power of data, the amount of data that these big tech companies hold will actually threaten the existence of existing insurers. And yet, we also see some of these attempts failed. Many naysayers believe that no matter how much people want to disrupt insurance, the industry just has too many variables in underwriting and in pricing for us to do so. Moving closer to home, Singapore insurtech map is as busy as it can be. About a week ago, Straits Times reported that the total insurtech investment in Singapore quadrupled to about 100 million last year. And just for a fun fact, Southeast Asia is actually the most invested only after US and China globally. But what does the number actually tell us, right, about the digital insurance trend in Singapore? If any of the regulators are ahead of the trend, MAS could be one of them. So about 6 years ago, in 2025, DPI was actually born, and MAS mandated the availability of insurance purely online across the industry. A close look at the number reported by LIA has shown that the sale gradually reduced over the years. And even last year, when COVID hits and everyone moved online, the sale did not actually pick up. Did MAS not meet their original intention of advocating a transparent distribution and to avail insurance to every Singaporean? Not quite so. I believe the MAS purpose was not just to promote DPI, but a much bigger reason behind it. Since 2015, there were many initiatives that followed, such as the launch of a sandbox that allow insurtechs to innovate within an experimental regulatory framework, or granting of the first digital insurer license after 40 years to Singlife in 2017. And when COVID forced us all online, we have seen waves of digital initiatives sweeping across both the traditional insurers as well as the alternative digital distributors. And to prove that there is an effect, right, LIA's figure now showed that the number of policies that are distributed online quadrupled last year. And even more so, the percentage contribution to the total new business premium actually increased by more than 10 times. Just the latest Q3 LIA figure showed for Singlife alone, the total new business premium sale of online policies tripled that of 2020. So that shows you, in fact, actually, there are movements within the industry that is telling us that digital insurance is growing and growing very rapidly. Such mixed message. So actually, how do we interpret this and why so? First of all, we must acknowledge that the challenges are real, and it manifests in multiple forms, and it also brings about defiance across different players, being it either insurer or the digital distributor, the regulator, the reinsurer, or the tech provider. So take the simplest and most common example amongst the insurer, right? Is, and 64% you have voted for it, which is the channel conflict. I've worked with many heads of digitals from various insurers in Southeast Asia. And one question I hear the most is whether we have a ready platform from Swiss Re for them to launch digital products as fast as possible. And the simple reason is because if they bring that back to their IT department, digital product would fall to the bottom of the prioritization list. In China and Australia, Swiss Re launched iptiQ platform, which is to address exactly that challenge. In Southeast Asia, iptiQ is not here yet. So the way that we address the challenge is through our partnership with middleware provider who allows that technical capability to happen. Another example, and this is quite interesting to observe, I have also worked with different digital platforms who have presence across multiple markets globally. And one ask is to offer the same insurance product in all markets. And they do this for simple reasons such as technical constraints and scalability or resource optimization. But the regulatory landscape is so diverse. For the same product, it's not very uncommon for the customer data required to be very different from one country to another, or simply just the type of distributing license the digital platform has to own is also very different. Just give me a moment. The kids are in the room, and let me just have a minute. Apology for this. Sorry. Yeah, since COVID happens, this happens quite commonly, and I believe that it happens to all of you as well. Apology for that. Yeah, sadly, we cannot expect to be this to become viral anymore, right? Like the BBC reporter just 3 years back. Okay, let me get on with this. So a study by the Geneva Association published in March 2021 also found that overall, government policies, digital infrastructure, privacy and data protection, and general culture and mindset of the population were not perceived as hindrance to digital business models. However, 1/3 of the respondents said that the insurance regulator framework was unaccommodating and created the biggest challenge to digitalizations. And at the end of the day, insurance is not a commodity, right? Especially life and health is a very complex financial product that requires our consumers to be very financial savvy to seek out for. And when there continues to be a lack of a burning platform, when our insurers continue to see huge investments as a hindrance or external constraints such as a regulation to deter the digital effort, it's common to see us taking shortcuts to make do with what we have. For example, taking our user complex products and market them on the digital front, or targeting the same customer base as the agency force. And this in turn results in mediocre outcome that we have seen. So the question is, do we have time to wait? By now, you may have formed some view through the mixed messages we have seen. Industry internal challenges are real, but there's one factor that all of us should never ignore, and that is the voice of the consumers. Each of us here plays a role as a consumers too, and the evolving world is shaping our behavior where we are much more comfortable online as opposed to talking to a stranger. In fact, I believe many of us actually look at our phones more often than our own family members. And I'm sure you also believe Google more than you believe an agent that you speak to for the first time, right? So it's no surprise that more than half of our consumers are more likely to purchase insurance online compared to other channels. And this online interface may include our traditional online website from the bank, from the insurer, but also alternative distribution platforms such as the e-commerce or e-wallet platform. Looking back at this behavior in the last 1 year, it's also astounding to see that the number of consumers who did purchase insurance online in the first half of 2021 is the same as those who did through the traditional dominating agency or banker channel. And the intention is clear that they prefer the experience and could do so much more often in the future. In fact, actually 50% of them say that they would purchase online as opposed to just 22 to 28% who saying that they're going back to the bank and the agents. COVID-19, as we have talked a lot about it through the whole day today, further exemplifies the need for us to have this insurance protection, and especially so in the emerging part of the world where we are right here in Southeast Asia, where insurance penetration remains at a low level. Hence, it is the best time for all of us to capitalize on the awareness and willingness of our consumers. And if you still don't believe in the consumer's voice, it's worth taking note that the world out there is empowering our consumers more so than ever. While we tend to take the shortcuts and stick to our traditional offering, our customers want more values. They want dynamic engagement. They want more personalization. And new technology are enabling them to do so. And they are available at scale, such as the wearables that we wear every day, the smartphones that collect our real-time data, the APIs that are connecting the ecosystem and the users' interactions, and especially the cloud computational power to help us process and transform data into insights that are valuable for us. So that is why insurers, as well as the partners, all of us need to evolve and adapt to the new normal and the market dynamics to ensure we stay relevant. First step we need to do is to basically understand who our customers are. So of course, if you assume the consumers are the same targeted audience we are familiar with through our agents or banker, we'll see less of a success. The truth is, the customers we are facing today are a lot more financially savvy than before. And the existence of such websites such as MoneySense, MoneySmart help us to get instant advice about what type of protection do we need and for how much. We also see the rise of new customer segments and needs that we have never seen before, such as the gig worker. Fun fact, There are now about 754 million of gig workers across Asia, which comprise more than half of the total workforce. In Singapore, this number stands at 0.5 million workers at this moment. And this includes a wide spectrum from your user Grab drivers to project freelancers and consultant. And just about two months back, during our National Day rally, our Prime Minister Lee Hsien Loong has voiced his concern and placed much importance on our insurance sector to provide the financial security for this segment. Secondly, we also need to deeply understand who are our real competitors. And this would come from different sources. One, your traditional competitors are incumbents such as AIA, Prudential, GE, who would likely avail their products online. Two, the same competitors are now leveraging technology to tailor and personalize their product offerings targeted at very specific customer segments, such as how DPS, OCBC pre-select customers and offer them products through their online banking app. And most recently, Snack by Income is a great story about how insurance can be sliced and diced and embedded into every walk of life. But lastly, and most importantly, the trend to watch is the ecosystem. In China, we have seen Alibaba, Ctrip. In Southeast Asia, we have seen how Grab, Traveloka, GigaCover innovating and offering insurance to a segment of customers we have, where we traditionally do not have access to. According to Oliver Wyman, the estimated revenue growth of this channel is 76% year on year, much higher than that of the other digital models that we have seen. So what does it mean by digital ecosystems? These are platforms that brings together the suppliers as well as the consumers. The common characteristic that they have is a huge user base and essentially much higher frequency of interactions between the platform and the users. By 2025, McKinsey estimated that these platforms would contribute to 30% of the total global revenue, and that is significant. So in the last 5 years, we have seen insurers starting to realize the crucial role that this digital ecosystem play. And across Asia, we have seen efforts to unplug the potentials through various partnerships. The trend is still emerging, and to say that we have found a successful commercial model is far from the truth. All players, including the platforms, the insurers, and the middleware providers, are still experimenting with various different products and services. It would take a while longer for us to converge and also to find a mature partnership model across the industry. So it may be useful for us to take reference to some case studies that we believe have set the pathway for Asia. Many of us could agree that Alipay is probably one of the most successful models out there. Alipay is the super app every Chinese knows of. And with the advantage of a huge user base, they have 1.3 billion users across the globe. Also, the explosion of tech innovations and adoptions, Alipay has made huge leaps into the insurance foray. One of the most successful or famous products that they have online is Xianghu Bao, which sold 100 million policies within the first 1 year. The price point is so low that it is almost a no-brainer for anyone who uses the Alipay service, and it can start as low as below $1 per year. There's a lot of controversies about how such model is walking around the boundary of regulations framework, but yet this has created a movement that paved ways for many other insurance products that are ultra successful on Alipay or other Chinese ecosystem. One noteworthy aspect is how Alipay was able to leverage data, in this case, Sesame credit score, to select better risks and achieve a preferable rates for their consumers. And this continues to be the foundation that they set for any other insurance product that they launch. Similar to Alipay, we also have WeChat, which garnered success through selling all sorts of insurance from mid-end medical to CI, PA, or travel insurance. And again, leveraging data that they collect about the consumers, such as financial or social activities. WeChat was also quite successful in introducing what we call an O2O model, which stands for online to offline or offline to online. So the user basically can view the product details and click make a reservation, and which would connect them to an agent via WeChat or call later. So moving back to Southeast Asia, Grab is a well-known homegrown brand that has made its name known to the insurance world. Similarly, for other super app or e-payment platform such as OVO, Gojek in Indonesia, Boost in Malaysia, or Momo in Vietnam. And we see embedded bite-sized insurance as the signature product that across all these platforms. So, for example, Grab between 2 years from April 2019 to March of 2021 has managed to issue a total of 130 million micro insurance policies. And it's a very impressive number. So with the bustling scene of digital insurance in Southeast Asia, where is the competitive edge, right? We all wonder if the potential is so large, why have we put in so much effort to penetrate this segment, but it still seems like an uphill run? To examine that, if we take another look at what our consumer is looking for post-COVID, the majority of them, actually 80% of them, want a cheaper product to start with, followed by the ability to process online or the flexibility to pick and choose the type of coverage that is right for them. So this seems to point to the direction that a bite-sized cover that breaks down our product construct to a minimalist could be appealing, right? That's why at Swiss Re, we also have a suite of modular products that we can embed within various wider ecosystems players. However, we all know that the price war is never the answer to a sustainable strategy in the long run. And commoditizing our own offerings has a short-term effect and will lead to lower customer retention in the future. So the question is, how do we achieve scale while maintaining the strategic competitiveness? And the answer is in what our actuaries always love, and the power of data. Swiss Re Institute forecasted that the real-time data grows at the speed of 39% year on year, which means that the amount of data that we have today will double every 3 years. And it's not just the technology that is enabling this. Even our consumer attitude towards data sharing is very promising in APAC. As long as the value is communicated transparently, we have a good chance of getting the consumers to open up and share the data to us. And I think some of our previous speakers have touched on how data can be used throughout the insurance value chain. And for every single step in this value chain, there is opportunity for us to have a targeted engagement with the consumers using data. For example, we can easily detect a happy life event through social media posts, and it is an excellent opportunity to offer insurance upgrade. Or we can also leverage digital footprints to predict risks and simplify the whole onboarding process for our consumers. At Swiss Re, we mainly look at 3 kinds of personal data for risk assessment. One is health and wellness data, 2, financial data, and thirdly, alternative consumer data. Some of the examples. So health and wellness is the closest and probably the most valuable data to life and health insurance. Besides the normal biometric data that we use for our underwriting, lifestyle data now also plays a very important role in determining risk. At Swiss Re, the spectrum of usable lifestyle data is still expanding beyond the usual step counts that we have seen being deployed in a few models previously. at the end of the day, it makes complete sense, right? That if I have slept 8 hours last night and have drunk 8 cups of water by now, I should be a healthier version of myself and should have a better mortality and morbidity risk. Financial data, on the other hand, though a little bit further apart compared to health and wellness, still give us valuable insights about a person's habit and lifestyle. Example, spending pattern can tell us if one is a heavy smoker, if he or she purchases a packet of cigarette every single day, versus someone else who frequents a supermarket to buy fresh groceries on a frequent basis. In China, the uses of credit score to offer policies ranging from term to health with preferential rate is quite a common practice by now. And lastly, alternative data from digital ecosystem is opening up many unprecedented opportunities for us to think outside of the box. For example, purchase pattern on e-commerce platforms could signify a major life event, which is typically the best time to upsell insurance. So in a collaboration with one of the biggest e-commerce in China, not only do we, as Swiss Re, create a specific mother and child protection targeted at the customers who purchase infant milk on the platform, but we also incorporate behavioral economics to continuously monitor the risk when the child is growing up. And from there, further fine-tune the whole risk control model, leveraging on different data points such as consumptions, financial or medical data that we collect through the ecosystem. And this brings us back to the importance that this ecosystem is playing. The massive user base and multiple engagement touchpoints allow the data to be interpolated. Coupled with an explosive data technology, the ability to collect, store, and most importantly, interpret the data makes them an irresistible avenue for the insurers to collaborate with. So if we are to ask ourselves again, the answer to whether we should be digital ready seems pretty obvious by now. If you still have some doubt, I'd like to invite you to go back 250 years to examine waves of innovation. So in 1942, Joseph's computer coined the theory of what he called creative disruption, which suggested that our business cycles actually operates under long waves of innovation. So from the very first wave of textiles and water power in the Industrial Revolution, and coming to the internet revolution in the 1990s, you can see from the graph here that the cycle longevity continues to be shortened. We are now in the sixth wave, and this is marked by artificial intelligence, digitalization across different industries. It will likely paint an entirely new picture for all of us in the very short term. This wave has started, and if we risk becoming obsolete, if we don't recognize the significance or the speed that is coming at us. So earlier on, we talked about how regulations pose one of the biggest challenges to digital success, but even regulators are taking steps to make changes to allow companies to test and fail fast, so we can all build a model that lasts in the future. And this is a common trend that I see across Southeast Asia, India, as well as Singapore, Malaysia, and even Thailand. So I've come to the last slide of my presentation, and there is a funny story behind this image that you're seeing over here. So about a year back, I was doing a presentation to the top management of one of the biggest insurer in Singapore. And the group CEO saw this picture and asked me, why are we suiciding together? We should be rising up together instead, right? It was a fun moment there, but at least we benefited from the humor. But then again, this is definitely not a suiciding act. In fact, it's one of the most skilled sports. Formation skydiving is the most skilled sports that many of us admire. And there are many lessons for the insurance industry to learn from this sport, where taking risks seems to be at the central point for both of our business. And in order to land down safely together, it's not about an individual's effort. The whole team must work in synchronization, just like it will take our whole industry collaboration to leap over the tipping point together. And while doing that, the alignment of interest and vision is very important. We need to land at the center point. So here we should all remember that personalized product and services leveraging digital ecosystems, partners, and insurers for data capability are crucial to our success. At the same time, communication is essential. It takes time to build trust with our consumers and to maximize effect. An omni-channel approach where we bring in the human touch is as essential as being technology focused. And with that, I have ended my presentation and could open the floor for any questions that you have for me.
Thank you, Joycelyn. Let's kick off the Q&A session. Maybe let me start with my question first. So I think when the earlier part of the slides, you did a poll, saying that, whether you believe in the digital channel, and if not, what's the major challenges you have seen. So for me, like insurance is always a push product. You need someone to agent sitting down with a cup of coffee, trying to convince you to buy a policy. So how do you think that, the digital channel will try to overcome that hurdle? And if we gonna move on to a digital channel, there will be definitely some cannibalization between, the traditional FA or the agency or the banker models. So how do we do the transition while ensuring there's a smooth growth in the top line of all the insurers?
Yeah, thank you, Robin, for the question. And I think one aspect that I briefly kind of mentioned in my presentation is how we segmentize and look at it from different perspectives. So I mentioned before, if we are targeting the same customer segment as our agency, our banker, or our other channels are targeting, we potentially will be cannibalizing our own business, right? And it also has proven that actually digital may not work as well to that customer segment that traditionally our agents or our banker has been going after. And that has shown in terms of the lower penetration that we have seen across a few digital use cases in the industry. However, if we shifted our viewpoints to a group of customer segments that we have never ever, or we have had very little access to before, we will see a lot of potentials. We also talk about the uprising of new customer segments that we have not been able to see before, such as gig workers. And this provides us an avenue for digital insurance to actually play to our strength of decoding the needs of these new customer segments, of leveraging alternative data to understand their needs and provide them the essential protection, which is different from our traditional channels.
Okay, thank you for answering mine. So now let's move on to the Q&A board. So the first question is, how does the digital scene in Singapore compare to the rest of the Southeast Asia or Asia? And where do you see the potential for digital insurance beyond Singapore?
Yeah, thank you for the question. I must say that it is a bustling scene in Singapore for the digital insurance. Not so much because we have a big population, indeed the opposite. We actually, compared to other markets in Southeast Asia or even Asia, the disadvantage of Singapore is we have a very, very small targeted base, right, from a population perspective. However, their regulations, flexibility, their technology adoption are actually opening up many opportunities for us here in Singapore. And I have seen many digital players using Singapore as a base to extend our reach to the rest of Southeast Asia and even Asia. And in terms of potential for digital insurance beyond Singapore, I do see it. I do see a lot of discussions and interest in markets, in emerging markets such as Indonesia or Thailand or Vietnam. Of course, India is also under my purview, and I see India as another uprising China in the very near future.
Great. So with that, are there any examples that the digital ecosystem actually translate into volumes or profit for the insurers? I think the one who asked the question, it appears that ecosystem are just another form of intermediaries, a more powerful form that gets the same, if not more commissions.
This is a very interesting question, and yes, it is. It is a trend that I observe where some of these digital ecosystem actually demand a higher commission compared to our traditional channel. And the way they are able to do that is because the product that we are providing to them is pretty commoditized, right? And it comes to a price war where they can demand the lowest from the different providers, such as the insurers, and yet they can take that product and then distribute to the customers where the customers don't have a benchmark of where the price point is. So that leads to the issue of how we have been collaborating with ecosystems, but I don't see that as the final goal for us to actually collaborate with digital ecosystems. It's not about the product, to be honest, in my view. It's about how we can leverage the various different insights and data that this digital ecosystem is holding the power to. And back to the first part of the question, where I have seen it turning into profits, I would say China is the very good example for us to take a look at. Even though some of the players like Alibaba or WeChat have been offering very cheap products to the market, I think the key to their success and the key to allowing them to have such a big volume that turns into profits is really the ability to make sense of the data that they own about the customers. And hence the way that our actuary cost for the risk is no longer the same, like the way that we usually look at our population or insured data experience to cost for it anymore.
Interesting. So just an add on to that question. So for the successful case study in China, right? So I guess they already leverage on Alipay and WeChat Pay. So they already have a very big platform that has a extensive accessibility to almost the entire nation. So if this is going to replicate or roll out to other countries, is that a prerequisite for success?
It's an interesting question, and I don't have an immediate answer to it. I think it needs to build on different factors. It's not just a big customer base that will definitely determine success. If you have a big customer base and if you have a very low penetration, it's back to ground zero, right? Yeah. And the key question here is actually how to improve the penetration within that customer base. So even though you have a smaller customer base, but if you have if you can combine different aspects from not just product but also data, behavioral economics, and using all of this to have a combined force to market the product in a way where it resonates with the customers and where it addresses the actual needs, then I think having a very big user base like what Alibaba, Alipay or WeChat have is not a prerequisite to the success of digital insurance.
Okay, then good to know. At least Singapore, it will be successful. Okay, we'll just do one last question that's coming from a different perspective. So could you please comment on the data privacy issues and change in the regulators' attitude to this in the context of growing data sources?
Yeah, I think this is indeed one of the biggest challenges that we have seen in the past. And as I briefly mentioned in my presentation earlier, data protection, actually, according to Geneva Association, is not one of the biggest hindrance. And why it is so is because we are seeing movement across the regulators to allow data transition across borders in many parts of the world. And Singapore is actually one very good example where cross-border data transfer is now being signed between Singapore and various different governments across the globe. And this movement continues to be advocated across the industry and across the different regulations. And I believe that in the short term, the regulators are now also opening up and also see the importance of data playing an important role in closing the protection gap amongst the population. I think, of course, data privacy will continue to be a very hot topic and a sensitive topic indeed. When we see Facebook having been under a lot of fire about how they handle data privacy. And in Singapore alone, I think MAS is also experimenting with a few frameworks such as the FIT framework, which stands for fairness, accessibility and transparency. Sorry, I cannot remember all the four, but it's basically advocating the need for all the different financial institute to be very transparent about what they use the data for. And as long as we incorporate that framework into the way that we use data, that would definitely address the key concerns about data privacy over there.
Thank you, Joycelyn. So we'll just wrap up for this session now. Thank you, Joycelyn, and thank you for all the